My name is Rolf Rosenkranz and I'm here at the European Development Days in Brussels. And with me is Christopher Clubb, the Director of Early Transition Countries for the EBRD in London. Christopher, thank you so much for being with us.
Thank you, Rolf.
What is the priority that you have right now in your job with regards to early transition countries?
Well, Rolf, the early transition countries for EBRD are our 10 lowest income countries. They range from the poorest in Tajikistan, which is a low income country, to middle income countries like Georgia. And the priority for us is essentially to improve what we call transition, but in the economic development words is largely the economic development of the countries tied to market-oriented principles, moving institutions and financial sectors and governments more to a market-based economy.
How are you partnering with other organizations, for instance the European Union, on some of those initiatives?
Excellent question. Rolf, EBRD has been at this game since 1991. I would say over the last 6 or 7 years, the European Union has become a much more significant partner for us in these countries because of two regional programs they've created called the Investment Facility for Central Asia and the Neighborhood Investment Facility. We partner, as a matter of fact, the EU is our largest partner in these low-income countries because the EU brings donor funds in the form of investment grants and technical assistance funds to actually improve the lives of people in these countries.
And oftentimes people in the development space say that economic development is not the panacea. Social development also needs to happen. So how does EBRD take that into account?
Well, that's an excellent question. I can assure you, though, EBRD is focused on what we actually know, what we do well. We are a financial institution that's oriented around the private sector, so 80% of our financing is in the private sector. So most of our projects are oriented around helping local businesses and local financial institutions invest in their domestic economies, invest largely in capital investment to make their economies better and stronger. And we hope, as a result of these economic progress and financial progress, that the lives and well-being of the actual citizens of the countries will become better and the tax base of the country become better, contributing to the actual government revenues to spend on healthcare and education and so on.
And you've been a banker for a while, for a couple of decades. Now, how have you changed that field over the years?
Well, I would say this. I would say that the biggest movement in the last 25 years over my career has been more or less an orientation between distinguishing what does the public sector do well and what does the private sector do well. And many of us have learned the lessons of the past, including the EBRD. And we're focused on providing value added that we can into our particular areas. So for example, in Central Asia, the Asian Development Bank is an excellent partner of ours, financing a lot of things in the public sector. And we are in complementing them and actually financing the private sector. So I think the biggest movement I've seen is, although there's more institutions and financial companies engaged in this activity, we need to understand what do we do well and how do we partner with others to achieve the impacts that we're collectively looking to achieve.
What about egos? There's a lot of egos in development and a lot of organizations want to put their stamp on development. Now partnership is becoming more and more common. How does EBRD handle that? For instance, if you partner with the ADB in Central Asia.
Sure. Well, in my experience, certainly in the last 11 years at EBRD, I can say that when it comes to ego, there may be more ego involved in international financial institutions that we're not necessarily partnered with. The ones that we've been partnered with, on a professional level, at the management and executive management level, we just basically engage with each other and basically learn from each other on how we can actually realize projects in particular countries to achieve the outcomes we're looking for. So I must admit, Rolf, it has not been a big concern of ours at EBRD, the ego. We have had presidents from different countries, all of which we've been able to interact with other financial institutions quite well. And I can't remember a time over the last 11 or 12 years where major egos have gotten in the way of us actually delivering our projects in our countries. I must admit, some of the political personalities in some of our countries can be challenging, but ultimately at the end of the day, if you can provide a good value proposition to the personalities in our countries, they actually see the benefits of the project and the benefits of engaging with EBRD and others.
Talking about value proposition, how does a company that wants to partner with EBRD or wants to get some funding from EBRD, position itself, present itself to the bank?
Well, we are, unlike a private sector financial institution, we have a public policy mandate to do things. So we have what we'd like to describe as sound banking. Each euro that we actually provide in the form of a loan or euro needs to meet sound banking criteria. And we would go through that very much like a commercial bank would. But what we're looking for is something consistent with our whole mandate, which is transition impact. So we have to work together with the private sector, whether it's a financial institution or it's a private company, to look at their project and see what can be done either as a mainstream part of the project or a tangential part of the project to improve the well-being and lives of particular people in the country. So for example, energy efficiency in our countries of operation is a very, very big part of what we're trying to achieve in the European Union. Therefore, we look at every one of the projects we'll finance and see whether or not there can be an energy efficiency component to a project.
And you talked about innovative finance. What sort of new avenues of finance, co-finance, impact investing is EBRD exploring right now, and how might that affect your partners or other people in the industry?
Well, I would say that the biggest activity in that area that's new to EBRD is local currency financing. Rolf, I don't know if you're aware of this, but the majority of financing from international financial institutions in the form of dollars or euros. As a result of that, especially the fragile economies I'm working in, are bearing uncalculated or large amounts of FX risk. So we, over the last 3 or 4 years, have been doing as much as we possibly can to do a higher percentage of our financing in local currency. And donors, like the European Union, have been very integral in actually risk sharing with us to bring local currency into these markets where there has been none before, in order to make local currency loans available, number one, in the first place, and number two, at reasonable interest rates in an economy, thereby reducing the large foreign exchange risk that financial sectors, financial institutions, and companies are actually bearing.
I guess I'm wondering, the pumping of money into an economy, local currency, how does that affect the society at large, not just the government that is receiving that loan?
Sure, absolutely. Well, the government, we're not lending to the government, just to be clear. We are lending these local currency dollars, local currency amounts to financial institutions and private sector companies. If we lend them to the financial institution, it's usually for a small or medium-sized enterprise. So almost 100% of this financing is making its way into the private sector in the hands of businesses that are selling their goods and services domestically. So what this means is that over one economic cycle, these countries usually experience one large depreciation. And when the large depreciations come, the non-performing loans in these countries go up dramatically. And as a result of that, sometimes the sovereign, the government, needs to actually inject capital into the financial sector. So we hope over a whole economic cycle that will reverse a lot of the non-performing loans. These companies will be able to stay in business and remain viable and won't go into default or insolvency for bearing unhedgeable foreign exchange risk.
What would your advice be to traditional aid groups that are not necessarily in the business that EBRD is in, but that are trying around innovative finance mechanisms, loans, they're toying around with impact investing, and so on and so forth. Everyone is trying to get a little bit of the skin in the game. Is that, you think, the right approach, or should everyone just sort of stick with what they're good at?
Well, listen, I think there's no monopoly on innovation. I've been working in this business for the last 22 years, and as a matter of fact, we've only been really active in local currency financing in many of our countries over the last 3. So I think it's very beneficial for those of us that are on an institutional level, like ourselves or IFC or the Asian Development Bank, to actually work together on the big picture issues and try to actually bring in private sector enterprises or private sector investors into those parts of the community, those parts of the economy that can actually be quite productive. So we're looking at bringing in the private sector, and we're financing a lot of the FDI coming into the country to actually improve the economic opportunities in the country and the jobs in countries.
Interesting. Well, I'm sure this is a conversation we can continue for a while, but I think the coming years will tell what success we'll have, especially in those transition countries. So we'll be watching closely.
Thank you, Rob.
Thank you.